In this video, we're going to discuss the pricing strategy referred to as high-low pricing. We'll talk about what high-low pricing is, how is it incorporated, and also how it compares to some of the other common pricing strategies, namely penetration pricing, price skimming, as well as everyday low pricing. And we'll also talk about some of the recent changes in the market that have made it very difficult to utilize this particular type of pricing strategy. First, let's start with a brief description of what high-low pricing entails. So high-low pricing involves setting prices that are higher than everyday low pricing, which we discussed in our previous video, but also having special sales where we price a particular product lower than competitor prices. So really how this works in action is we might, during a particular week, choose to heavily discount specific items within our store. And the focal point of that, or the focus really, is to try and drive traffic into the store with the hopes that people would purchase other items. So increasing traffic really becomes a focus of this particular pricing strategy. And that's really how it varies in comparison to everyday low pricing, which is really probably the closest pricing strategy to high-low. And then instead of ensuring just a consistent price point throughout the course of a given period of time, with high-low pricing, we're going to make some significant changes. And so we may heavily discount an item one week and then the next week move it back up to its original price. And so overall, we might have higher prices than an everyday low pricing structure, but we're going to methodically select certain items that are of interest to consumers, and then we're going to select items that in large part consumers would really respond to if we do lower the prices. And we have a term for this. We commonly refer to these types of products as loss leaders. You've probably heard this terminology before. And these represent products that we generally as a business lose money on. We've designated these products as products that are, one, consumers respond to very significantly. So if we were to decrease prices, the demand for these products would just increase exponentially. But also, we want to drive traffic to other areas. And so if you look at the way that many retailers choose to price during the holiday shopping season, this is a very common strategy, right? If you open up an advertisement during this time of year, you'll notice that typically the front few pages are all televisions, and those are drastically reduced. And the whole idea is to get people into the store, and maybe they'll walk out with other items that are of higher value to the company, meaning their profit margins are much higher than some of those loss leaders are. So how does high-low pricing compare to some of the other pricing strategies that we've already talked about? Well, let's first kind of do a brief review of some of the other pricing strategies we've discussed. So on the y-axis, we have price. On the x-axis, we have the quantity of goods that are actually sold in a given period of time. So if we're first kind of going into, let's say, penetration pricing, we know that penetration pricing involves setting a low price point, and then as we acquire market share, we gradually begin to increase prices so we can be profitable. We also discussed what we call price skimming, which is almost the exact opposite, where we set a higher price, and then we gradually begin to lower the price over a period of time. And this is usually to recover those developmental costs early on, commonly seen in pharmaceuticals and also with electronics. And in our last video, we talked about everyday low pricing, which is really just kind of a pricing strategy where we simply just set a low price, lower than competitors, and we maintain that price, and we don't do a great deal of sales promotion. The idea is we're going to ensure consistency. You can find links to all these videos in the description below if you want to brush up or learn more about those pricing strategies. So for this video, though, we're obviously talking about high-low, but I want to mention those so we can talk about the differences between the 4 different pricing strategies that are used. So with high-low pricing, what we're actually doing is we have a normally high price, but then what we do is we lower the price point to try and increase the quantity of goods that are actually moved. And this is a very temporary thing, though. So with these other strategies, mainly everyday low pricing, which is a relatively close pricing strategy compared to high-low, instead of maintaining a consistent price point, we're dropping prices rather dramatically to try and move product. And again, the whole idea is to increase traffic in the stores and sell some of the other higher margin items. Now, there's a couple of trends as of late that would maybe reflect in this pricing strategy not being as strong as it used to be. And probably the poster child for high-low pricing would be Jcpenney, which is a retailer of various clothing and different items and has been around for many, many years, but as of late has had some financial difficulties in large part because of their pricing strategy. In our last video, we talked about everyday low pricing and the consistency of traffic. High-low pricing almost works the opposite. The goal is, again, to ensure getting traffic into the store. But what often tends to happen is by offering these really heavy sales promotions week in and week out, is you begin to train your consumer to really just kind of expect those kind of promotions. And so what begins to happen is people simply don't come into your store unless there's some kind of promotion, because there's this fear that if you purchase something in the store, the next week it's going to be 30, 40, or 50% off. And so you begin to train your customer to expect these promotions, and then so your sales become really volatile. If you're running a promotion, people are in the stores, and if you're not running a promotion, no one is coming to your stores in large part because no one wants to pay a higher price. The other big assumption that you make with high-low pricing is that people are going to purchase multiple items. And what may happen is people might come into the store, but they might just purchase that one item. And that is in large part what's happened as a result of technology and online shopping, is that people are becoming much more used to single item transactions. And if you think about the way that Amazon Prime and mobile shopping has kind of changed our habits, we are far more likely to check out with simply one item in our cart now. And online shopping has really changed that. And that's kind of translated into stores as well. So Jcpenney has, within the last couple years, tried to change their pricing strategy. They actually tried to go to a everyday low pricing strategy. Their CEO, or former CEO rather, Ron Johnson, tried to institute this strategy and simply could not do it for a number of different reasons. But in large part, it was because the Jcpenney consumer was so used to expecting these types of promotions that they simply couldn't get used to the idea of not getting a promotion to come into the stores. And so their sales suffered significantly. Ultimately, their CEO, Ron Johnson, was fired, and they reversed course and resumed kind of this high-low pricing strategy. But it's very difficult to implement in today's market, where you have very price savvy consumers. They have access to a lot of information, and technological advancements and really just mobile shopping and those types of things have really begun to change people's habits to being okay executing single transactions or single item transactions, which largely negates any of the benefits associated with high-low pricing. Now, the other issue, and of course this relates to purchasing multiple items, is by using these really heavy sales promotions, our profit margins are very, very low for each of the items that we sell. That is actually the loss leader for that particular week or that period of time. And so generally, we're losing money on these items. And so we need the purchase of additional items under a high-low pricing strategy to actually be profitable. If consumers are just coming in and purchasing the item that's being heavily discounted, that's not going to be a very good way to sustain ourselves. And that's a lot of volatility as far as our sales go. So we need those items or those customers to purchase a larger number of items when they come into our stores. And so what this hinges upon is the success and the ability of the marketing personnel to identify key products that, one, if they heavily discount, will in turn attract customers to come into the store, but also their ability to kind of pair those items with some higher margin items to ensure that customers are checking out of the stores with multiple items in their shopping cart.